Reset is back with Vince-Lanci. Stay tuned. Vince, I'm so happy to see you again.
Happy to see you. Welcome back to you.
What a day yesterday, Vince. Would like to get your thoughts on the sell-off we saw with gold and silver. How much would you say was due to Bernanke's speech?
Yeah, we would have preferred to talk to you before yesterday when we were bullish. But we had a target in of between 1,800 and 1,805. It never got there. So a lot of money was left on the table in our own personal accounts. But to talk about the sell-off in gold and silver, a lot of the TV pundits with merit were saying that the sell-off was precipitated by expectations of Bernanke making some QE3 announcements or expectations of a QE3 being imminent. Him not doing that was the catalyst for the sell-off. Right before he came on the air, the PMI came out, and that surprised to the upside a little bit. That started the market weakening. But the market was hurt by other reasons, we think, as well. Yesterday was also the LTRO, the European mechanism for injecting liquidity into the banks, whereas 800 banks subscribe to about $700 million. Remember, they're paid in euros, and they don't want euros. They exchanged their euros for dollars as soon as they could, driving the dollar up, and that was another contributor to gold and silver sell-off. And the final reason is gold and silver just were, although they were strong, they were thinly traded on the way up, and that should have been an alarm that this market didn't have a lot of support behind it. And I think, smelling blood in the water, the bullion dealers just pushed it as hard as they could, and they won.
So on that note, Vince, why didn't we also see oil drop, since it's also a dollar-denominated asset? You know,
at first it did have a knee-jerk reaction lower, but the bottom line there is, throughout the years, everybody who buys gold because of fear of war in the Middle East, they're sorely disappointed in the past. If you want to hedge yourself against Middle East issues, you hedge yourself by buying oil. And I think the Iranian tension, real or imagined, is what keeps oil buoyed.
All right, Vince, let's move on to the topic of Greece. A former labor minister going on the record stating that she is upset that Greece's lenders will have the right to seize the gold reserves in the Bank of Greece under the terms of the New Deal. This is something that seemed to have slipped through the radar. What are your thoughts on this?
It kind of slipped through the cracks, but the New York Times reported this, that as part of the new latest, greatest deal with Greece, the ECB, as a lender, can confiscate Greece's gold as collateral if it feels like it's not being paid back in a timely fashion, et cetera. And this former minister, I think of Papandreou's cabinet, voiced concern about that. And we took note of that for two reasons. We see it as the duplicitous behavior of the major players in the markets. For one, you have the commercial banks, which are heavily short paper, silver, and gold, heavily, silver especially, and then simultaneously you have the IMF talking about creating a new SDR or depository receipt as a replacement for the dollar in the long term as a reserve currency. Meanwhile, but they never mention gold. Meanwhile, you have a plan to confiscate gold from countries that are defaulting on their debt. Now look down the list who the top owners in gold are. You know, there's the U.S., there's Great Britain, but in the top five with a decent amount of gold, I don't have it in front of me, is Italy. So while the commercial banks are short paper gold, and the conspiracy theorists will love this, while the commercial banks are short paper gold, the central banks are accumulating physical gold. So what does that tell you?
So is it a good time for someone to be buying physical?
That in and of itself that information alone would just tell me to buy futures. But it's the mechanics of the futures market that are concerning me right now. When the market gets too high, the CME raises margin rates to keep a lid on the, quote, froth. When the market sells off too much, the CME will lower margin rates because they're looking at their own revenues and lack of volumes trading. I think the gyrations in the market and the changes in margin requirements and the fact that the bullion dealers have the upper hand and the contract is so big is just driving away the retail investor. What's left for them to do? They can buy an ETF. Well, that ETF has counterparty risk. I don't care what the ETF salesman says to you. They can buy futures, but they're so leveraged and they're so at the whim of stops that they could get stopped out on these large contracts that they can't afford to take delivery of. It's looking more and more like physical gold is becoming the choice, not just of retail investors, but we're seeing it in hedge funds too. We deal with and consult with 3 hedge funds, and 2 of the 3 are now buying and taking delivery of gold and putting it in their own vault, offering it to their employees as well. So this, in the beginning it was a lunatic fringe that wanted to, you have to own physical gold. It was the gold, guns, and lawyers crew. Well, it's spreading up to more reasonable, more acceptably reasonable people of a higher pedigree. Physical gold is not going to cause you margin calls.
All right, now with the time we have left, Vince would like to speak to you about platinum and palladium. Offline, we were having a great conversation. And tell me why you've become a fan of platinum.
Well, Greg Saponis and myself have been watching the platinum-gold relationship for some time and just amazed that gold had been trading above platinum, attributed that to retail investment, speculation, and end-of-the-world stuff, and the fact that platinum is an economic metal. It's primarily an industrial metal, despite being precious. That spread started to converge, and we did a little research and saw on Bloomberg yesterday that most of the palladium in the world, and palladium and platinum have a relationship that is very closely tied. Platinum is used for catalytic converters. So if you have to use an ounce of platinum for catalytic converters, you have to use 2 ounces of palladium. So they do the same thing, just palladium is half as effective. Well, the above ground stores of palladium are in Russia, and Bloomberg reported that they will be depleted in about a year. So what you're seeing now is the setup for a short squeeze in palladium. How do you play that? Well, you look at the substitute metal, and that substitute metal is platinum. And sure enough, platinum and gold are converging again. Our conclusion is if we do have an economic recovery, then platinum is as good as owning as any stock.
All right, Vince, but if there's a shortage of palladium, why wouldn't I just buy palladium, which is less expensive?
Palladium is a little bit more than half the price. Gold is very liquid. Platinum is sort of liquid. Palladium is just not liquid. If you ever have to get out, you would probably have to pay too much vig, so to speak, in exiting. It's not readily traded in retail quantities. We would say platinum.
Good stuff, Vince. Thank you so much. We'll see you again next week.
Thank you very much, Daniela.
And we want to remind viewers that Kitco News will be headed to the world's largest mining convention next week, the PDAC in Toronto. We'll be bringing you exclusive coverage. In the meantime, you can email me, as always, at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.